Good morning, everyone. This is Marshall Gittler bringing you the morning comment for August 1st. Well, it looks like people are starting to believe that the Fed means business. Equities were down around the world while credit also suffered. One reason may have been the biggest jump in the U.S. employment cost index since the 2008 financial crisis, which makes people think that maybe there isn't as much slack in the labor market as had been thought. Less slack in the labor market would mean earlier tightening by the Fed. It seems we're starting to repeat, on a small scale at least, what happened back in May 2013 when then Fed Chairman Bernanke started to talk about ending the Fed's quantitative easing program. Back then, the dollar rose broadly against a wide variety of currencies. I'd expect to see that performance repeated, although perhaps not quite on the same scale. There was one big difference between yesterday and recent days, though, and that was the collapse of emerging market currencies. Dollar EM had gained somewhat on Wednesday, but on Thursday, the dollar just soared against almost every EM currency we track. It's actually EM weakness rather than just dollar strength, because Euro EM moved almost as much as dollar EM. The move may have been partly in reaction to the Argentinian default. That adds to the Russian sanctions to remind investors of the real risks of investing in the emerging market world. Now, so any FX market participants who have carry trades on should be really careful, as these sorts of carry trade unwinds can go on for some time and be quite deep. As for today, it's PMI day in Europe. The day starts with the manufacturing PMI figures for July from several European countries, the Eurozone as a whole, the UK, and later on the US. The UK manufacturing PMI is estimated to be slightly lower, which could pressure sterling. While in the US, the ISM manufacturing PMI is expected to have risen. But the main event will be the non-farm payrolls for July. The market consensus is for payrolls to rise by 231,000 versus 288,000 in June. A strong non-farm payrolls reading, along with an anticipated unchanged unemployment rate of 6.1%, near a 6-year low, should add to the recent solid U.S. data and boost the dollar further. Although, I must note that on average over the last year, dollar-yen, for example, has been lower a week after the non-farm payrolls than it was immediately before the figure, regardless of whether the figure beat or missed expectations. Now, I always hesitate to say this time is different, but I think this time could well be different, because this time the non-farm payroll figure only has to corroborate market thinking. It doesn't have to change market thinking in order to keep the dollar rallying. We also get U.S. personal income and spending figures for June, which are expected to have accelerated. Another good news for the dollar. On the other hand, the year-on-year rate of increase in the personal core expenditure deflator and core PCE are forecast to have decelerated a bit, which is contrary to the sharp acceleration in Q2 core PCE in Wednesday's GDP figures. For more information, including technical analysis, read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX Global, wishing you solid trading.